Hello everyone, this is Dr. Barry Burns with Top Dog Trading. Welcome to the Top Dog Swing Trading course. Very excited to present this to you because there is so much great information here that's helped me a lot, and I know it can help you too. So very excited to share it with you, and I am confident that it can help your trading tremendously. So let's get right into it. The first thing we're going to do is we're going to add another energy to our list of 5 energies. So remember in Foundations courses 1 and 2, we covered 2 energies in 1, we covered 3 energies in course 2, and in this course we're going to cover 2 more energies. The first is volume, and the second is relative strength. Both very important energies. I don't cover everything in courses 1 and 2 because, well, it's just information overload, frankly. So we got to space it out to allow people to absorb the information and to learn it over time. And I don't put volume into courses 1 and 2 primarily because I don't rely on volume as much as I do the first 5 energies. Those first 5 energies, I can trade on just those. Volume I use as more of a complementary energy, a supplement, but it doesn't always, on every single trade, give us definitive signals. So I look at it and I see what it's doing, but it's not a primary determining factor on every one of my trades. But when it does confirm, it is a very powerful confirmation, and it is something that I definitely take note of, and it gives me more confidence when I'm going to take certain trades when I see it there, because it really is an additional energy. It is not covered by the first 5. It is something unique. It's an extra energy, and it's a very, very important one, as I'm sure you've heard from a lot of other people, because I know a lot of students have written me saying, gosh, I'm surprised you don't cover volume in the first 2 courses because so many of the other teachers say how important volume is. Well, you know, we all have our different philosophies. Yes, it's important, but I guess I just don't give it as much weight as some other teachers do. And maybe you'll see some of the reason why as we go through these examples. Okay. So let's talk about the 7 rules of volume patterns. These are basically the 7 things that I look for in volume patterns. And I'm looking down here at what we call the volume histogram. And a histogram is just basically charting vertical lines like this. I've got them color-coded, so green means that, and by the way, just I think everyone knows this, but you can match these bars up. I'm not doing it very well here, but there's a bar that is actually directly vertically underneath each one of the price bars, and that represents volume for that price bar. And you can actually look over here and see what the volume number is. And I'm not so interested in the actual number. In fact, I never even look at the number. I'm just looking at the patterns that it forms, and this volume bar in relation to other volume bars. But this is not an indicator, so this is real. This is what is. And just like price is not an indicator, it is price. It is an objective reality. Same with volume. So some people make a big deal out of that, saying, well, that's the market. Price and volume is the market. And I won't argue that point. But the point that I would argue with is that doesn't mean that it makes it easier to trade with just those 2 things. In fact, I think indicators make it easier to trade with. That's really what their function is to pull things out of price and volume that's not immediately apparent to the naked eye, and to make them more apparent. So, but anyway, we're going to do a little bit of that later on with volume as we add a couple of indicators. But right now we're just going to talk about the raw volume data here as posted in the histograms. So the basic principle of what we're looking for in volume is extremely simple, and you may already know it. And by the way, just to share my charts here, we're not going to talk too much about the stochastic. We're not looking for trades right now. I just want you to be focused on the volume patterns that we're looking at down here. So we'll be just, noting cycle highs and lows, but don't worry about whether it's a valid trade or not. Don't get carried away with that. Remember, we're only making 1 point right now, and that is focusing on these volume patterns, just to teach you those. If I had to go through and point out every trade, it wastes a lot of time, quite frankly. So what we're looking for is, here's our 200 MA is the orange line, the 100 MA is the gold line, the 50 MA is the red line, and the 15 EMA is the black line. Alright, and then we got our candlesticks on there. Now, as price starts to move up, what we want to see with regard to the volume histogram is we want to see it supporting that move. So if price is going to be going up, we'd like to see volume going up as well. And then on the retracements against the trend, we like to see volume coming down, because volume is a force. It's literally not how many people are trading, but how many shares or contracts are going through. And so it really does make a huge difference. It really does matter. And we want to know that the market is going up on good volume, increasing volume as a general rule. Now again, there's going to be a lot of exceptions to this, but this is the basic thing we start out with. So volume supporting especially the early moves early in the trend, and not supporting the retraces in the trend. We want those retraces to be weak. And so we don't want a lot of people selling these retraces. We want people standing on the sidelines and for them just to kind of drift down. Now, one of the things that's tricky about reading volume is the histogram doesn't just form, nice, perfect, steadily increasing volume like this, where you could draw a trend line on it. And the same on retraces. It doesn't just then go nicely down into a nice little retrace. You can draw a trend line down that way. So if it did that, it'd be a lot easier to read. And it doesn't most of the time. Most of the time it's much more noisy like this. So you and it doesn't always match up directly with the bars in question either. So what we're looking for are just general patterns, or sometimes it's even just, you get a bar or two of big volume, and then you get this kind of general sloping retrace. This is good. Here, for example, okay, so this big spike causes this gap up. That is enough to cause this continued ride here. Then this retrace is very, very slight. And you'll see that not a lot of volume comes out of the market, but it does gently come out. And so that's just perfect. It goes right back to the 15 EMA. Now we get another push up, but really not on a lot of volume. Look at the height of this volume bar. And so therefore the market does not make a major move up. It just kind of makes a little move up, and then volume comes down even more on the retrace, or in this case it's just a sideways movement, but that is still considered a retrace. This is good, okay? This little move here, volume didn't really help you much because it's not showing increasing volume. Well, price did not increase much, a little bit, but it wasn't enough to send that price up very high. But then as we go into this retrace mode, or this consolidation mode in this case, volume does drop back down. And that's your clue that, okay, we didn't get a big push up this time on volume, but we're all on this kind of consolidation portion now. Volume's actually coming out again. And then when we put in this cycle low, boom, now we get the nice push of volume. And this does make a new high in the volume histogram. And that's enough to push it all the way up here. And so that, again, it doesn't always correlate. In other words, you don't always get the big volume bar right when you want it. And this is a reason why I say that I don't always rely on volume that much. But I'm looking at the overall pattern, and sometimes you just have to look at the retrace and say, okay, this retrace is on very low volume, that's good, and so I'll take that next cycle low, as long as, of course, everything else matches up. And you may not get the big volume bar right on your entry bar. But as you get in, after you get in, you continue to watch volume to see, is this confirming? And in this case, you will say, okay, I'm in. Oh, whew, good. Volume did pick up. Great. So I'm encouraged now. I don't have to play this so tight. Let's see, this thing probably is going to have some life to it now, and that creates this range as opposed to this range. See, on this range up, you didn't have any extra volume. This was a longer range up because you had an increase in volume. Okay, and then we just kind of flatten out here again. And then what happens is, well, we get, we'll talk about this a little bit later. So right now I just want to tackle one topic at a time. We'll get to the reverse the other time. So let's look at another uptrend here. Just do some uptrends, look at one side of the market to make things as easy as possible. And we'll look at shorts too, because people get a little bit confused on the shorts, on the short side of the market. It gets a little confusing. Okay, actually I'm going to change the scaling here. Whoops. Okay, we can look at this part. This is fine. So here again is a similar situation. Okay, we get a nice spike here. This gaps through these moving averages, comes back down. 50 MA is basically flat in through here. We get another move up. Okay, now this is our first real retrace in the trend. Now, here's what you're looking at here. We had a nice volume pattern right here early in the trend. So again, it's not the kind of thing where you get a nice even histogram that's moving nicely up. But we get a little bit of volume here, we get a lot of volume here. This moves up with volume. As the retrace comes back, the retrace is shallow in price. It goes to the 15 EMA. And volume comes way down, way down. Look how low it gets, way down to there. So that's like the lowest it's been for a long time. So that means there's not a lot of people selling here. Not energy. The energy is not to the downside. The volume energy is to the upside, not the downside. Now, it could go to the upside, and then if you had a lot of volume also coming down, well, then you'd be suspect. But with volume on the upside and then coming out of the market on the retrace, you're encouraged to take this long. Now again, we get in, we don't get any volume spike right on our entry. Volume pretty much stays flat here. But again, the market doesn't really go very far, does it? Doesn't really go very far here. It goes here and then just kind of consolidates a little bit. So it makes a little higher high. Technically your trade's successful. But, you know, there's not enough volume to really crank this thing to the move on that half cycle. And that's the key. I associate volume with the half cycle. So basically, volume is a short-lived indicator. You got to keep watching it all the time. Now here we get another spike in volume. Okay, and that's able to gap it. We get a gap, and that's good. And then volume comes back out of the market again, and it just kind of consolidates. But by this time, we're already, and here's the key: 1, 2, 3. 1, 2, 3 retraces in the trend. Okay, and waves: 1, 2, 3, 4, 5, 6, 7. Can you read my scribble? Let's do it again. Right. Comes up. Actually, yeah, that one's real close, but we'll just play it this way. 1, 2, 3, 4, 5, 6, 7. And that would actually be an 8 and a 9 eventually. Okay, but the reason I want to put those waves on there is to show you that you can't take volume in isolation of everything else, and it's just like all our other energies. We take them all one by one, and we say they're garbage. So volume is technically not an indicator, but it's the same with like candlestick patterns or anything else, or what truly are our indicators. By themselves, in and of themselves, they're completely and utterly worthless and unreliable with regard to making us money. Okay, I'm not putting down anybody's indicators, so don't start, emailing around and say, oh, Barry says all these indicators are no good. No, they're good, but I'm just saying you can't make money with any one of them in isolation. So what we do is we put together a probability scenario by taking indicators and price and volume, which are all independent. We don't want energies that are overlapping. Now we've got going to have 7 independent energies that do not overlap, that tell us each one tells us something different. Put them together and score the trade. And of course, the higher the score, the more energies that are saying the same thing, the higher the probability of that trade succeeding and following through. So part of that is, where are we in the trend? Okay, early in the trend obviously is going to be better than later. So even though we get a volume spike here, of course we don't get key down to 20 anyway. But again, just to make the point, we get a spike here, but we're already on the 3rd retrace in a trend. And so therefore that's really not what we're looking for, because now, yeah, volume might be coming in, pushing the market higher, but at the wrong time. Volume doesn't tell you anything about timing, and timing is absolutely critical. In fact, there's really not much more that's important in trading than timing. As they say, amateurs are right, but at the wrong time. So this is the time you do not want to be in, because that's when the trend ends. All right, let's look at another scenario. Okay, now we're going to look at it from the short side. Now, again, this is where people get a little confused sometimes, because we're looking for the same thing, but is kind of upside down. So now as the market is moving down, we want volume to move up, and as the market moves up, we want the market to move, or the volume to move down. But really the principle is the same, and that principle is simply this: as the market is moving in the direction of the trend, in this case the trend is down, you want it to be supported by volume, so you want it to increase as the price moves down. As price retraces against the trend, you want volume to move down to diminish on that retrace. Okay, now again, it's not quite that simple, but let's take a more accurate look here. So here we've gone into consolidation pattern. Here we're breaking through the 50 MA. Okay, and now we actually get a very, very clear pattern, one of the few rare ones where the histogram forms perfectly. And okay, and then it kind of evens out here a little bit. So this initial move is very clear. Then this one becomes a little more ambiguous. Okay, the volume, as we get a little retrace here, the volume does come down. Alright, price comes back down again, and volume does increase a little bit. Doesn't get up to this height though. And again, because of that, price doesn't go very far. It does make a lower low, but it doesn't go very far. Volume then retraces, it diminishes, and sure enough, price retraces, which is great. Then, kablambo, we get this huge volume spike, and we get a huge gap. And that's pretty common to get big gaps and big volume spikes like that. So, and then again, this big volume causes the market to be able to ride that volume for a little while. And notice too that as this market is going down, volume increases. We get a little retrace back to the 15 EMA, volume goes back down. We get our move back down, volume comes back up. Then volume kind of settles down here for a while. Okay, again, you get your retrace here, and that settles down. Notice again the timing on this is not perfect. It doesn't, the volume doesn't peak right at the cycle low, in other words. Okay, but that's still part of that cycle. And this is what I'm talking about. Volume will create an energy early that the market can then ride for a little time after that. So we get our retrace, and sure enough, volume diminishes. And then we get another move down, and volume does come back up a little bit. Makes some higher highs here. But then it just pretty much evens out in here. But again, at this point, now we are already deep into our trend. So 1, 2, 3, 4, that ends up being 5, 6, 7, and 8. And so really it's just a 7-wave pattern. Okay, so that's how you read volume to the downside. So those are the basics of volume. And now starting in the next video, we're going to look at some of the other rules of volume, which create some more elegant patterns than just the very basic volume increasing in the direction of the trend and decreasing on the retraces against the trend.